Imagine buying a property without enough money to pay for it. Sounds risky, right? But this is exactly how many real estate investors grow their wealth. They use other people's money. Bank loans. With the right strategy, this can accelerate your investment growth. But if used incorrectly, it can also destroy your finances. So, how does it actually work? Today, we're going to break down how bank loans work in real estate investing and how investors use leverage to grow faster without losing control. Welcome to Decode Advanced English on Wealth by Hana House, where English meets finance, investing, and real-world thinking. In our previous lesson, we explored the long-term strategies used by successful real estate investors. Today, we'll discuss a powerful tool many investors use: bank loans and leverage. Understanding how financing works is essential for anyone interested in property investment. To understand this concept more clearly, let's listen to our experts.
Bank financing plays a major role in real estate investing.
Indeed, many investors rely on mortgage loans to acquire property.
This allows investors to purchase assets that might otherwise be unaffordable.
However, loans also introduce financial risk.
Interest rates, for example, can significantly affect loan repayments.
Quite right. Investors must carefully understand the terms of the loan agreement before borrowing money.
Otherwise, they may underestimate the financial obligations associated with property ownership.
So while bank loans can help investors expand their portfolio faster, they also create financial responsibilities. Let's listen to a conversation between Liam and Sophie.
I heard many real estate investors use bank loans to buy property.
That's true. It's called leverage.
So they borrow money from the bank?
Exactly. Most investors use a mortgage loan to finance property purchases,
How do they repay the loan?
usually through monthly payments over many years.
What determines how much they pay each month?
Two main factors: the interest rate and the loan term.
So if interest rates increase, the payments might rise too.
Exactly. That's why investors must carefully read the loan agreement.
Sounds like borrowing money can be risky.
It can be, but when used responsibly, leverage can help investors acquire larger assets and grow their portfolio faster.
That was a very practical conversation. Let's break it down. What Liam and Sophie showed us is that bank loans or leverage can be a powerful tool in real estate investing. They allow investors to buy properties that would otherwise be out of reach and to grow their portfolio much faster. But at the same time, borrowing money also creates financial obligations. From this conversation, we can see three key factors investors must understand. First, the interest rate, which directly affects monthly payments. Second, the loan term, which determines how long the debt lasts. And third, the loan agreement, the legal terms that define your responsibilities. If you look closely, leverage is not just about increasing returns, it's about managing risk. Used wisely, it can accelerate growth, but used carelessly, it can create serious financial pressure. And this is what separates confident investors from those who take unnecessary risks. Now, let's decode some useful vocabulary from today's lesson. Mortgage. Meaning: a loan used to purchase real estate. Example: many homeowners finance their property through a mortgage. Interest rate. Meaning: the percentage charged by a lender for borrowing money. Example: rising interest rates can increase monthly loan payments. Loan agreement. Meaning: the legal contract between a borrower and a lender. Example: investors should carefully review the loan agreement before signing it. Reminder word: leverage. Leverage refers to using borrowed money to increase the size of an investment. Bank loans can be a powerful tool in real estate investing. They allow investors to purchase larger assets and expand their portfolios more quickly. However, borrowing money also increases financial risk. Successful investors carefully evaluate interest rates, loan terms, repayment obligations, and their ability to manage debt. Throughout this real estate series, we've explored many important concepts. In our next lesson, we'll review 15 essential real estate vocabulary words every investor should know. You've been watching Decode Advanced English on Wealth by Hana House, where English meets finance, investing, and real-world thinking. See you in the next lesson.